Hi, this is Randy Finney with the Right Side of the Chart, and today is Thursday, May 11th, 2023. The markets are now closed, and I'm going to do my final video of the week and final video until actually week after next. I'll be on vacation. I'm not bringing any screen recording tools or anything like that, just at most a laptop and my phone. So like I said, I'll get any market breaking or timely things I see out to you when I can. So let me do, this is video number 2, and here's what I'm going to cover. The first video is quite long, went into detail on the market, levels to watch, most importantly near-term levels to watch, both on the upside and downside, as well as my short-term, near-term, and longer-term outlook. And so this, I'm going to do pretty much everything else. It's not all inclusive, but I'm going to cover a lot of the trade ideas that I've shared in recent weeks. And it's going to be also, various asset classes. We're going to cover, start out with the financials, crypto, semiconductors, precious metals, and the currencies. I'll touch on treasury bonds, munis, and then kind of roll into the which is a related note, credit, watching credit spreads, bond insurers, throwing out a few trade ideas there lately. I'll touch on the ag commodities, but I can't go into detail. This will be a hour plus video, so I'll just talk on those quickly. And then some of the individual stocks that I've thrown out lately, individual trade ideas, or individual equity trade ideas. All right, let's dive into the charts here. Again, this one, we're not going to really cover the indexes, but more of reiteration to cover or to keep an eye on certain conditions in the market, such as breadth deterioration, negative internals. And that is, you can simply watch, there's many metrics, percentage of stocks trading above their 50-day moving average, 20-day stocks making new highs versus new lows. And you can do that with the NASDAQ and do it with the S&P. But one simple way is to watch the S&P 500 and the NASDAQ 100 and then compare them to their equal weighted index. So here's SPY. You're still within this most recent trading range. Divergence is still intact. SPY was down today, nothing much, down 0.17%, we closed at, but we had RSP, the equal weighted S&P 500, down 0.5%. And then you can look at QQQ, which, no surprise, continues to just kind of inch higher, up 0.33%. But when you look at the equal weighted NASDAQ 100, that pretty stark divergence continues. This one was actually down 1.8% and continues to lag, making lower lows recently with the regular NASDAQ 100, a la Apple, Microsoft, Amazon, Alphabet, the usual suspects, carrying it up to new highs. So keep an eye on that. And again, if you are bullish or don't have a position, you're just trying to analyze the market. Again, that's a sign of a healthy rally, is when you see all, the majority of stocks participating. That's it's a signs of a healthier rally. And signs of a very unhealthy rally is, like I said, very few stocks, fewer and fewer doing the heavy lifting. All right, let's dive into the charts. Financials. Okay, that's part of, again, I've seen just odd things, and I've chalked it up to, I have a little doubt that I think a lot of investors right now, both individual and institutional, if they both weren't buying, you wouldn't see the FANGs continuing up the way they have. They believe that, that they're just dismissive of the financials, and the financials problems are their problems, the big banks, and it doesn't matter because Apple keeps selling a lot of iPhones and they're going to keep making money, et cetera, et cetera. And, if the trend continues, if the banks, if we have other failures, banks that need to be bailed out, other big problems, and not just the banks, I'm going to talk on that in a second. I give you as much as to the extent as I can give you my word. There are no guarantees. I can all but promise you that if you see the financials, some bigger problems that require government intervention, again, financials go down, big banks, a bank failure, or any, again, of the non-bank financial entities, which have ballooned in recent years. There's been quite a bit of talk about this. They are not as regulated heavily as the banks. And we all know what happened. The banks are the most heavily regulated financial institutions out there, right? And we know what happened. The Fed was clueless with Silicon Valley and then the other failures we've had. We've had three of the largest bank failures in U.S. history just in the last couple months here, and it's not getting better. And so where I'm going, so if those are the most heavily regulated financial institutions out there, but the others have grown, ballooned in recent years, in part due to that regulation. There's what they call the non-bank lenders and other things out there, and so there's wow, there's just maybe it doesn't materialize, but there's a lot of reasons to be very cautious and a lot of things that could break. And again, this is how it all starts. One thing starts breaking, you see cracks. It's like a big dam, and the more cracks that start forming in the dam, Fed's been plugging their fingers in some of these holes, but the cracks still appear to be forming, and so whatever, we'll see what happens. All right, so FXLF is the big financial sector ETF. Obviously, you want to watch that one. And then what I encourage you to do is take a look, dig down on the components. I don't know how many other charting programs do this, but I have a list. You're not seeing it in this monitor. I've dozens of charts going, but this list will sort by winners and losers each day. And this is a trend. So remember, you had the market rally recently, figuring, okay, well, the Fed acknowledged and they missed Silicon Valley and some of the other ones, but don't worry, they're on the ball now, and they assure us. And J.P. Morgan tells us, Jamie Dimon tells us the banking sector's solid and blah blah blah. Okay, well. So the regional banks had their little short covering rally, and as I said, many had or still have divergence. It's really what I call unconfirmed divergence, because you have to make a bullish PPO. My book, this is not, I don't think it's in any other textbook, and I didn't write a book. I'm just saying in my book, using that term metaphorically speaking, I like to see when you have the indicators making higher lows and higher highs against prices making lower lows. That is, technically speaking, that's positive divergence, but I like to see that bullish crossover on the PPO to effectively put in a lower trough, because they're momentum indicators and they're heading lower and they can continue lower. And be careful, be a little leery of bullish setups and bullish divergences in a bear market, if that is what this still is, as I'm going off of, because they quite often don't play out. In a bull market, you want to gobble up divergent lows, especially on the daily chart. And if this is a new bull market, then guess what? You're probably going to do better in the regional banks than just about any other sector out there. So there it is. If you're bullish, and I know some of you are, I see the comments, this is what I'd be buying. But I think this area is toxic for fundamental reasons. And, if the worst was over, why are they still being sold? So we'll see. Blame it on the short sellers, blame it on what you want. I can tell you, me, I'm an avid short seller, but I'm very leery to short any of the regionals directly, because the short covering rallies can be explosive. All you have to do is get caught on the wrong side of that. And trust me, Washington, as well as the Fed, they're out there watching this. They want to ban short sellers. They want to shore up and do whatever they can. And even if those attempts don't work, the short selling ban will not ultimately, but it could cause a explosive short covering rally. All right, let me just move on. Just watch those, and I just wanted to point out that these are just some of the components of XLF. You see, we got a little relief rally, and the divergences are still potential, but we don't have the crossover. I'm just going over some of those today. What happened today in XLF, TFC, Truist Financial, Regions. See some of these, and quite a few. Oops, there's one I jumped over. Huntington Bank, one of my former employers, making new lows. Today was pretty much matched the previous low. We're right at the new multi-year low, 52-week or aka multi-year low on this one. And many of these, again, positive divergence. So things are going to go one way or the other soon. If I'm wrong, and the October lows didn't mark the end of a bear market, a new bull, then and we're going to go much higher in the market. Sooner or later, these regionals will probably stabilize, but no guarantees. Anyways, I just want to point out, when you look at stocks like this one, Huntington, you have this beautiful looking bear flag. There's your flagpole. There's your bear flag. Take the measured move of the pattern would be the length of the flagpole. But again, bigger risk is some of these banks may fail. More of the, I'm sorry, not some. Some already have failed. More of these banks could fail. So watch this. This is a red flag again. Let me look at KRE. So, we want to watch the regionals more directly. Look at KRE. Again, potential divergence. Started to rally the other day, but they faded most of that rally already. And when you look at, the big one is Pac West. We know what's going on out in California, or most of us do. We know San Francisco is sort of ground zero for the, or one of the ground zeros for the commercial real estate problem. Basically being that, everyone stopped going into the office when COVID hit, and then they decided, hey, we can work from home. And so there's a ton of office space, and you can read up on it. It's just, I see no way out of it, really. Unless all of a sudden there's just a craze to fill that office space. There's going to be, and there already are, massive amount of loans on these commercial properties coming due, and they have no choice but to refinance, in many cases, vacant buildings at higher rates now. And this is not limited to the regional banks. It's not limited to the big banks. It spills over to private equity. It spills over to pension funds. It spills over to insurance companies and everyone else that had their hand in that cookie jar. So anyways, watch these and just know that you're going to have this kind of erratic trading, and you have the potential to have these things stabilize and start to rally. And if they do, I probably won't nail the bottom on it, but I'll hopefully get in and catch, a good percentage of the move up. If they melt down, then it's going to spill over into other areas in the economy, especially if you continue to see more failures. So I'm just going through a few of these. Bank of Hawaii, also flirting with that previous low right there. Same story on almost all of these. So it's kind of do or die time. If these guys, again, you're seeing the NASDAQ 100 go up. It's like I said, let me use this phrase, the tech is fiddling while the financials burn. Again, it's almost as if tech's saying, or investors are saying, Apple's problems aren't anything to do with the banking sector's problems. And they are. The financial crisis, Apple didn't have any problems. They were selling more cell phones than ever, and more people downloading apps through the App Store. But it didn't stop Apple from dropping whatever it dropped, 50-70% off the highs, whatever it dropped in the last bear market. And I'm just using that example to apply some Microsoft and all of them. So there it is. This one melting down. This looks like, I think by now, the smart money out there, the multi-billion-dollar hedge fund managers and pension funds and all that, where the big money is, and people are making big salaries to do their job. I think by now they've had time and they know where to look, and they're digging through the books of these regional banks. And so if there was this value, a lot of the bobbleheads are coming on TV and telling you right now, the regionals are fine. Why are they still selling off? Is this all short sellers? We'll see. If it is, there's going to be the biggest short covering rally you've seen soon. But usually where there's smoke, there's fire. And I'm just clicking through here. I didn't even select I just sorted the watch list. You can see some of these banks, there's problems in the regional bank sector. Doesn't look like it's over, in my opinion. Okay, there it is. So watch that. I don't want to beat a dead horse. That's one of many sectors. Again, there's other sectors in the subsectors in the financials. One I gave you is a trade idea right here. So remember, this is twofold when I do these videos. A, what to watch for potential red flags. There could be other issues in the stock market that can take the whole system down, and nothing's probably more important than the banks, right? I think we can all agree on that. And then trade ideas. And this one I gave you as a trade idea, and it gapped down. There was still plenty of meat. We hit our first target. That was my first target there, 771. It bounced, could have covered, sidestepped the initial snapback rally. You had a brief intraday overshoot, and it's starting to move lower. And so on next sell signal, it should go down to the next level and then the next. And this is in the capital market sector. These are components of IAI. And again, I'm doing this to kind of give you a big picture. This is B. Riley Financial. There's a clean downtrend line. Look at your 200-day moving averages. So it's a tale of two tapes, kind of like a little playoff Dickens classic, tale of two cities, tale of two tapes, tech, and then everything else, and especially with the banks. look, guys, if let me pick a sector. If I don't want to even use something as big as biotech, some little niche sector. Let's just say it was. I'm trying to find one that almost doesn't matter. There's a lot. Okay. Oh, let's just use basic materials because that's one of the top 11 sector. One of the 11 sectors in the S&P 500, but it has a small weighting. If I saw, basic material stocks really melting down like this, I wouldn't be overly concerned. It does have some kind of implications that the economy is not strong. Basic materials, concrete, steel, things like that. Yeah, if they're dropping, then it shows demand's most likely dropping. But they in themselves really don't have much potential to bring down the entire financial system. Okay, financial companies, broker dealers, a big failure of a broker dealer. Think Fidelity. Fidelity doesn't even trade publicly, so who knows how it's doing right now. Things like that. Again, these are the things I'm watching, and I'm just going to rifle through a few more. This is my watch list, or the components of IAI. Well, there's one right there. HLI, Houlihan Lokey, right there on that trend line. A break of that trend line would trigger an objective short entry, and there's some price support there. A first target, a high probability first target, means I'd give very good odds of it being hit. That's about a 12% drop, then 24, and so forth and so on. And before this bear market is over, I will put very good odds this stock is going to at least 53. It's at 90 right now, so you could have a 40% gain. Now there's no sell signal, so watch it. And there's a little triangle, like a lot of things. So this market can pull a rabbit out of its hat technically and start breaking out of these levels. More power to it. So you don't short it here, you short it right there. Okay, and you watch it. Even if you don't care to short it, keep an eye on that and all these others. It's all collectively, because we don't know which one. What if I'm correct and there's going to be another big or multiple other shoes to drop? It's hard to predict exactly where it is, but not as hard as you think if you watch the public, at least those publicly traded companies. Because again, watch their stock. The insiders know, those that work for the company, they tell their friends, family, even though that's illegal, it happens. They're selling the institutions, the smart money. Hell, the damn corrupt politicians who don't have insider trading rules, those in the Senate and et cetera, that know what's going on. They sell or short. It doesn't matter until they aren't allowed to do that anymore. So that's it. This one already broke down. LAZ, Lazard. I'm just rifling through this list. Trying interactive brokers. I talked about that one. Already failed that quad high right there. False breakout, still below it. It's still an objective short when it fell back below 80, and any rally up to that level is. I don't want to see this one fall, or I'm going to have to pull money out of that broker. If it not here, it's fine down here. If you start to see a waterfall, if these stocks, any one of these big brokers start to look like the regional bank stocks, there's trouble there. Okay, so just keep an eye on them. And then we have the insurance companies. Again, huge industry. And I, pretty familiar with how they work. I used to be a licensed insurance agent in my previous life and sold. We'll look at that. Let's look at life insurance. Let's pick on the life insurance sector. I was a life, health, and variable annuity license. So I've sold everything from term and whole life and universal life to fixed annuities, variable annuities, index annuities, immediate annuities, you name it. And so I'm going to go to life insurance, and we're going to look at a few of these guys here. Okay, here we go. Here are some life insurers. And I'm just, in no particular order, I'm going through these. I'm rifling through the ones that stand out. Here's MetLife, just broke that. That's a pretty good support level. This chart I haven't fine-tuned. I'm going to take that line away. You can see we had a reaction high there. More recently, a reaction high there, and we just broke it. Like many things in the financial sector, I will say there are potential divergences. So if it can, rally up, great. But right now it's below the 200 days. That one doesn't appear to be at big risk. Here's Lincoln National. Worked for them, sold their products in the past. And this is not looking good. Here's a stock at a 52 or multi-year low, coming up on their financial crisis low. There's a problem here. And again, what I know about these, and having to work this industry, is that they park, the way they make money. We all know how they insure, but they're putting their reserves a lot like banks in mostly into government securities, government bonds, treasuries, mortgage-backed securities, things like that. They can spread it around some real estate investments. So they were exposed, and these guys are big, and they are systemically important, especially if you start to see a lot of even just one big failure.
Market
So
data
let's
connection
just keep an eye on those. Right now, there were a couple I saw that stood out, and I'm not seeing them. I should have had it in front of me, guys. I'm sorry. I've been going through these lately, and maybe it's a property and casualty. That's the one too. I think there's an issue there potentially, or some issues. Property and casualty. And let me do it this way. Insurance.
Market data connection re-established.
It's right here. And let's just see who stands out there. Well, there's one that's a setup, HRTG. If it falls back below this downtrend line and then breaks this trend line, you can see negative divergence. And here's a stock that's also, well off its highs. I'm using log scaling. This thing was a $16 stock just here at the beginning of 2020. Now it's a $4 stock. And it recently flirted with penny stockville. It was $1, and they stepped in to defend that $1 share price. And obviously it has sympathy with the stock market rally. But we're going to watch it. That was one that's punching down to new lows right there. And there's one that broke out but ran right into resistance. Lemonade. Here's a big one. This one looks like ripe for a short trade here. Let me see if I can put a downtrend line on there, which was just recently broke out. You've got big negative divergence on this one. But look, it already hit 30 cents. A lot of things, everyone started buying, especially the meme traders, getting these short stocks that were heavily shorted, priced for death. You don't short a stock that's 30 cents. I don't, at least. I don't short penny stocks. But this thing is not out of the woods. And when I look at a long-term chart, and I'm not queuing that up, this video would take forever. This thing's still not looking very hot, despite the rally. UVE, again, big divergence right there, Universal Holdings. Let me sort it by market cap, because that's going to give you a better idea here. The big ones. Chubb, one of the largest in the sector, $82 billion company. Negative divergence right there. Broke the wedge, little flagging. I highlighted that one as a short trade too back here. And it's been walking its way lower. Progressive, my own insurance company. I explained. Oh, I'll give you an update. So remember, I told you guys I've been in the arbitration or appraisal clause process with them, where they did, and this is known down here in Southwest Florida. I'm not going to say complete blanket denials, but everybody's complaining. Everybody's still waiting on insurance claims. It's been, in my opinion, there should be major class action lawsuit. They've had a strategy of just not denying claims outright, but coming in with very low and reasonable offers for clear damage to the homes down here. And some people, unfortunately, don't have the time or money. They have to take that settlement. They don't have the time to fight it or the know-how. Others have gotten lawyers or public adjusters. And so, as I said, the damage, I think has been underestimated by a lot of these insurance companies. They thought that policy would work. I'll give you mine example. I told you recently they offered me originally, I think, like half of my $12,000 deductible, which was a joke. And the roof itself, half my roof tiles are all over the yard, lost half of that. It's clear at minimum needed a roof. That's $83,000. I had 3 quotes from 83, 90, and 100,000. They're slate tile, and you got to do the boathouse. So and to come back with a $6,000 offer is ridiculous. And then when we rejected that, came back for more, they immediately invoked the appraisal clause, which then entails me to go out and get my own adjuster at $300 an hour for 40 something hours, and then they have to put their own out there. So they settled. Anyways, that's a binding thing. If their adjuster that they hire independently of mine agreed, and they did, and they agreed on 170. Why am I telling you that? Well, to show you the disparity there in the process. Now that is binding. And when I called the other day to see how long it's going to take, spoke to them, they said, "Oh, your adjuster, the one working on your case at Progressive, he's what did they say? Modifying the oh gosh, I'm sorry, I'm drawing a brain fart, but it was something to do with the loss reserves or the expected. They had set aside a certain amount for that case, having no idea what would come in. And I can tell you, from talking to other people, it should have been more than that. And so where I'm going, if there was a term they used that indicated that they in their books they expected this claim might come in somewhere obviously much lower. They have to accept that, as I mentioned, that appraisal clause is binding, and so they're going to their books. So where I'm going, it would not surprise me to see a lot of these property and casualty companies and the reinsurers, guys. Don't forget about the reinsurers. We all know Progressive, we all know State Farm, Travelers, Allstate. Everyone's heard of those. They buy what's called reinsurance company that insures them if there's a big disaster and it exceeds their reserves. And so the reinsurance companies got whacked too. And again, these there's very, very much the potential that there'll be repercussions throughout the financial industry if, as these claims are finally now 8-9 months after Hurricane Ian starting to be settled, and they have to come back. And the market doesn't like when companies come back after they've already said, oh, okay, here's our loss estimates. They're contained. We had reserves. Oh, no, we got to come back and tell you, we need to do an adjustment to earnings because we had larger than expected losses. So Progressive easily down here to 106.71. We already hit my first target there. And that's another 20% drop. And I would put good odds that before all said and done, we're coming down here to 84. That's a 37% drop in Progressive. Travelers, and again, I'm going through the big ones now. Divergent high right there. And I'm just showing you the daily charts, and I'm showing you the near-term targets. If I flip over to the weekly charts, you'll see things. I have to turn on all my lines and all my indicators. You can see that stocks like these, Travelers, big divergent high on the weekly. This indicates a considerable drop, in my opinion, and a lot of them are looking that way. Allstate, well, there it is on the weekly. See, that's why these videos, if I do them properly, thorough analysis requires multiple time frames. Long term, there's a long-term trend line, broken, back tested there. That ends in my opinion, a long-term cyclical bull market, a very long, I won't even call it a secular, more of a, this is a secular bull. This right here off the 2009 low is a cyclical bull, but now we most likely fall down, and I'm seeing that on a lot of them, and I can put up all the trend lines. You'll see the same thing. So anywho, those are the things I'm watching. Some of those are actionable trades. Some are just, hey, where's the next shoe to drop? Maybe not. And again, if you're the bull mindset, then you want to see these companies stabilize. You want to see them hold support, start to rally. Okay, next up, crypto. So recently put out official trade ideas with price targets on Bitcoin and Ethereum, and you can use these. If you don't trade futures, you can use GBTC and ETHE. We had a bearish rising wedge, so this one was to be a short on the break of that, and we did. We hit my first target, consolidated around it, went through it a little bit, and we're, for all intents and purposes, that second target's pretty much hit, but I'm not going to consider it hit yet. I think we can get a little more out of it. 14, remember, that's the actual support level where reaction's likely. And there's also a gap there, so you could say, look, it's certainly respecting this gap. So in hindsight, maybe I would have put the target there, the top of the gap. You can see right there, top of the gap, hit it once, hit it again. So more of a support zone. Now we're still there. We just closed there. You could cover, but I think this one has a lot more downside, and I still maintain at least T4, and I may extend that. T4, if hit, my fourth target is going to be another 25% downside in Bitcoin. Ethereum, we hit the first target there, which was the trend line. We shorted that one. We nailed the high, I believe, if I'm not mistaken, the day of the high right there, or one of those two. They're both the equal highs. Hit the first target, which was a trend line. Hit the second target, which was 877. And effectively, again, we've been dancing just like Ethereum, a little bit above that third target, but I still think it goes. And again, you can see the big divergent high here. We're starting to roll over, and T4 is minimum. And you know what we'll do right now? Might as well. Let's make it official. T5. All right. I may not remember that I added that later, so sometimes you see the initial charts. I'll show you, but no, let's just do that now. Since I'm going out of town, and if things happen the way I think they do while I'm on vacation, things could happen fast. And here's the actual crypto. I don't trade the raw crypto, but you could. BTC, you can see good support there to 27,200 right there. We've had a couple of spikes below it, so what I should do, and I will do right now, is put a BOD support level up, benefit of the doubt. Comes in, and what I'm doing here, guys, I'm capturing these spikes right here that came down below, and that's right where we are. But pretty much this is already broken down, and that actually correlates with that gap on GBTC that I kind of missed earlier. So, but we're below it, the gap. I'm sorry, but we're still hair above the GBTC target. But I think when this breaks, it looks like thin air down to the next target. Remember, this all started with this divergent high, beautiful bearish rising wedge breakdown, and Bitcoin has been stair-stepping lower. It was running with, the king of risk on assets, which are tech. But even Bitcoin's rolled over now. It's like literally Apple and Facebook and Amazon are carrying the whole market up single-handedly. If you trade futures, this is what I trade and what I have, BRR, Bitcoin futures. We're going to have to roll the Mays soon. Expire May 26th, or the May futures. 27,105, really nice support right there. You can see that. And we just cracked it today. So that should open the door to my next target, 25,780. And then if things get ugly, we'll probably continue all the way down here. I could certainly add another target right around somewhere in the middle there. But again, I think if I am correct, things may start to snowball here. So Bitcoin kind of do or die right now. It needs to snap back above there. But remember, we put in a divergent high here, and we've been stair-stepping lower. I don't know if I have an Ethereum chart marked up. Let's see if marked it up on the 6-month time frame. No, I didn't, but I can show you right now what we've got here. It looks like a little divergent high there, almost divergence there. Same thing. You just really, what I'd focus on, let me step it down to the hourly for you guys that trade the crypto. Really, you have, just like Bitcoin, you have a support shelf here. And we're right on that right now. Just started to crack it today, but you can see we cracked it a few times there, so we call it a support zone. Much more downside, and I think you'll start to see money come out of crypto. And so there's another short trade. It's going to help. I will say this. It's going to help to see the markets roll over. So I already did that in the other video. Levels to watch on SPY, and especially QQQ, because QQQ right now is the risk on king. And again, even some of these risk on assets are not doing well. Despite big tech, it seems to be, again, single-handedly carrying the market. But watch for that. And again, it will sharply increase the odds if you have those sell signals on QQQ on the 60-minute time frame that I mentioned earlier start to trigger. That will help the case for crypto. There is the other side of it. You can say that, hey, money's going to flow into crypto because of if you're right on the banks and the financials, Randy, people are going to buy this as an alternative. Maybe, but hey, it's one of many investments, one of many positions in a portfolio. So it's okay if you're wrong on one or two, if 3 or 4 are going up at the same time. And gold started to resume its luster. If you recall, many of the crypto heads wrote gold off, even though for thousands of years it's been considered a store of currency, an inflation hedge, a flight to safety asset. And everyone said, oh, gold's dead because Bitcoin's here. Well, yeah, no, that was didn't prove to be true. But lately, I pointed out we had negative divergence building and still there in gold. And I think gold, in my opinion, you know me, I was very, have been for years long-term, unwaveringly long-term bullish since, bottom back in 2015, just calling, with corrections along the way, waiting for the next big breakout, the new highs. When you look at the weekly, gold is really just, look, you can see this is a weekly chart here. This is the previous bull market high back in 2011. We came up there, tested it again. We're right there. So gold, sooner or later, will probably break out. The problem is, you check out these divergences. You have them. They show through all the way here on this weekly chart. When I say ADH, it's almost a divergent high. We're right below that previous high. But if we do make a marginal new high anytime soon, still going to be a divergent high. Could pop. I think sooner or later it'll pop. I think this is just a consolidation, big consolidation trading range. Ultimately will probably resume to the upside, but it could take a little while. We could have another thrust down, and that's how I've been positioned, as I've told you. And it's just like kind of the QQQ trade, a little early on it so far. We've gone nowhere. We started to go down. We hit support, went up, but the divergent high that we had there only got bigger and still there. And you can see that. And so that could send gold down here, one area, maybe a backfill. There's some gaps down in here, something like that. Let me show you silver. Then we'll get to the futures. SVL. Silver, as I said, I tend to, when trading the metals directly, I'll usually do a higher weighting in silver. You get more bang for your buck. It's just like trading QQQ versus SPY. You get the call right on gold. Silver is going to go that way, just usually more, whether it's a bull trend or bear trend. So silver, like gold, just put in a divergent high recently, and down another 5% today. And it's probably going to come back, at least in my opinion, come and test this. There was a trading range there, and we just hit the top of that. So that is support. You can see I had a number there at 222.27. I created that back in November of 2022. But when you look at this, here's our primary correction, called a bear market within a larger bull market downtrend line. And we'll probably come back and back test that at minimum. And that's still a little more downside there for silver. GDX, same thing. This was last long, T1, T2, T3. Started power up, and then we shorted it right there, nailed that exit, got out of there, even though I still was maintaining a longer term swing or trend target at the time. Shorted it, hit my first two pullback targets, then we put in that divergent low, we got long again, and that's where I started to, somewhere in here, I called it a soft pivot, where instead of looking for a much higher moving gold in the miners, I figured that the upside would be limited. So I was a little bit early there. I started shorting the miners back here, but that's where we got a sell signal on that breakdown. Hit that T4. I left it there. You can see that was created back in 2022. Hit that T4 level. And if I modified it, it would have been moved. Yeah, updated it April 25th. Anytime you drag or move them, change them, put them at a different level, it tells you modified on or updated. Anywho, its big resistance was, and you can see to the button, hit it with negative divergence, just like gold, just like silver. No coincidence there. Just like, silver is more of like a leveraged play on gold. Same thing with GDX. They just move up and down with gold, but usually more than gold goes up or down. And so far, and I reiterated it as another push up there, we hit it 36 and it's down 7-8%. 33.10 already got hit once. So we'll probably, if we come back at it again, there's a better chance we'll go through it. And I wish I was around. I'll give you any thoughts. I don't know. If you shorted it here, you can just trail stops down. I can tell you this, you can't trail GDX with a 1% stop loss just day to day. There's too much volatility. It's going to stop you out. But let's look at the futures of the euro, and we're almost done with this video, guys. GC, this is my hourly chart, 60-minute candles, and you can see diverging, negative divergence. That was what was pointed out there. We had a little wedge and a breakdown, but it hit this support, which is why we're probably going again, 1893. But we went on, made a marginal new high. There's been a lot of volatility in the markets with the Fed and all that. And so far, that high also, we've been stair-stepping lower. 2015 was and still is support. If we break that, that's going to open the door, increase the odds of 1893. And just kind of like Bitcoin, a lot of those risk-off assets, or risk-on assets, risk-off, you have pretty good support there. If that breaks, that's going to be even more bearish. I would have to give you my opinion at the time if and when we get there. And again, I may not be around. Just know that if you think it's going to break and you get down there, you might want to, it's hard to say how it's going to go. It could go back test, go down. There's a downtrend line. I'm just giving you levels to watch. And like I said, I wish I was around for the next week or so, especially if the fireworks start to light up in the market. This is that six-month chart. There it is, divergence. You can see it better here. And I've got a lot of levels. It really depends on the next thing I'm going to show you, which is a euro. Let me just give you silver real quick. Okay, silver just broke. There's that. Look at that. It's a beautiful little trading range, just like QQQ's range. So you had a smaller range at first. You had a pop, another pop, and then it couldn't hold it. Went straight down and right through the bottom of the range. So that's a breakdown. So if you're short silver, or if you want to get short silver now, it's a little late, but you could short a kickback to 24.83. But really watch gold. I never trade silver in a vacuum. I always trade it with gold, one eye on gold. And so if gold rallies up, maybe there's another level, big level, 25,434, the midpoint of the range. And based on the scope of these divergences, how large they are, I think there's going to be some more downside in the metals here. Euro US dollar, of course, that's what it's all about. Not time to do it in this video. You can do it yourself. Overlay a chart of the Euro US dollar or the euro with gold, and you will see an unmistakable positive correlation. They move up together, which is the same thing as the US dollar and gold, which have an inverse correlation. They go different ways. And so forever and a day, I've been tracking these divergences here. I was bullish off the lows there, but then, especially the recovery. We had that false breakdown, whipsaw on the weekly, went up, and then started diverging here. We put in a divergent high. We had a little wedge there. It broke down. That gave us that previous correction in gold right there. Then we hit this other trend line right here and went up, and the divergence, the same divergence, it's even larger now. And right now we're at support. We're just right on. We cracked it technically, but it depends how you put it. You can play around with this. You can go like this, or you can drag and hit that reaction low, and then there's a trend line. So if you want to do that, call that the BOD, or benefit of the doubt trend line. I had it there because you had more reactions on these candles, multiple candles there. Either way, close enough to any more downside. If we take out today's lows by quite a bit, that's going to be a breakdown. And when you look at how big these divergences are, that could be a pretty sizable correction in the euro, which means a rally in the dollar. I'd say at least down here. That's going to bring gold and silver down more. And, if it gets real ugly, maybe a back test. Who knows? Again, we'll have to kind of play this one as it goes. And this is my chart of E7, the euro futures. So here's a pure play on the euro. Look at that. Look at that resistance right there. 111.25. Look how many failures there. 1, 2, 3, 4 distinct failures. This trend line goes to the left of the chart. I cannot, if I zoom out to a longer time frame, I have to change the period of the candles, and then all these lines go away. Well, I'll tell you what, why don't we just do it and draw one? I guess we can do that, right? It was on 2 hours, so we can go to, we need to do 1 year, 8-hour candles. We'll do that. And there's your trend line right there. So that is a powerful trend line. It's nice and clean, and we're right on it. And we just put in a divergent high, so that increases the odds that that level can break. Actually, the divergence goes all the way back there. So that's it, and that could easily bring us down right here. And if we get that, again, you can play around with the charts. What I like to do is study these. I'll correlate, levels, look at the correlation, try to gauge how much gold moves in relation to the euro. And if that's, where we're going, I would say that's a pretty likely target. That's pretty good move down in gold and silver there. So no sell signal yet. Remember, support is support until and unless broken. So we haven't broken down yet, but we're very close, at least on the euro futures here. Okay, almost there. So that's it. Gold, silver, crypto, bonds. Treasury bonds have been a trading vehicle for me for months now. Every now and then I throw out a long or a short trade setup. Sometimes I've taken treasuries lately as hedges to index positions, long or short, based on, risk on, risk off asset, risk on, risk off trades. You look at the long term, most important thing. And again, if you're new to the site, I like to reiterate this, why I seem so damn gloom and doom for longer term. This is the trend in interest rates. You can put it on the 30-year bond. This is the 10-year bond. These are the yields. TNX are the 10-year bond treasury yields, which are, if you're only going to watch one maturity on the bonds, it would be the 10-year. Even 30-year mortgages track the 10-year treasury bond more so than the 30-year bond. So this is an important bond. It's right in the middle, there. And a lot of institutional traders, and really it's a good gauge on where interest rates are going. And this was the end of a secular bull market in interest rates, peak in inflation. I remember as a rookie broker in Merrill Lynch back in the early 90s, people coming in with, some of these older ladies coming in, or guys, gals. Remember one particular 15% treasury bonds, that they had bought back then with 15% coupons and CDs and things like that. Crazy, right? But that's what rates were back then. And then we had a super well-defined downtrend line, which was broken out. And by every metric, and I've covered this many times, a higher highs, series of higher highs, taking out downtrend lines, fibs, every metric that I have says that the secular bear market in interest rates is over, and we're in early stage now. It could be a long time. These are secular trends. Please understand, I'm talking a trend that started back right here in the very early 80s. So this was a 50-year downtrend in interest rates. And so that's why I think, and you can't use this for your swing trading and positioning, active trading. This is kind of more of, hey, I'm going to open a business or buy a farm or something that's longer term. You might want to think that understand the impact of rising rates, if I'm correct, and we're looking at not just a brief blip in inflation, which the Fed is, they're already declaring the battle has been won and all that. No, you'll see abatements. Nothing goes up forever. This was a huge move off the bottom. These were artificial rates. These were your three or several bouts of quantitative easing and artificial excessive manipulation where you drop down below the channel. And that one did it. They finally broke it. They finally did what the textbooks forever said they would do. You print enough money, you're going to get inflation. And they thought they were getting so cute and clever that, hey, we'll never have a recession again. We just keep doing different rounds of quantitative easing. Every time there's a little hiccup, we bring rates back to zero. And there's not been a sign of inflation. And that worked until it didn't work. And so that's where we're at. Now, where am I going? Okay. Watch the treasury bonds. But again, to me, they're more of a trading vehicle. I've given you trades lately on ZB. You get more juice trading the long bond because of the duration. The duration is how much a bond will move relative to change in interest rates. So a 30-year bond has a higher duration than a 10-year bond, which has a higher duration than the 5-year bond. There's your big resistance there. And remember, this is the bond prices. So if this goes up, and it can in a flight to safety bit, if the market melts down, I don't know, really. And this is why I'm talking about this being a trading vehicle. I like to short, rallies into resistance or breaks of trend lines. I like to go long on pullbacks to support. There's support right there. I think the last trade I told you I was targeting that 129 level. We're in a critical juncture here, and we could trade just like the stock market. Remember, QQQ has been trading sideways, so has the 30-year bond here. Fundamentally, I can go either way. On one hand, we have the debt ceiling coming up, and we know the Republicans and the Dems are not playing nice. They're not getting along. So expect the next thing to rattle the market. They're going to take that down to the wire. And if it gets close enough, which it probably will, then you're going to see nervousness in both equities and in the treasury markets. And if we can't get our financial house in order, that's a negative, net negative for treasury bonds. If you're Japan, how many more U.S. treasuries do you want to buy if we just start, let's just say Biden gets his way and free money for everybody and tax the wealthy and all that. It's going to be very restrictive for growth. They're going to print more money to pay for the current bonds that are coming due. We're in a rising rate environment. You know how much debt we already have, and you know what the cost to finance that debt. The Treasury, again, assumed that we'd have perpetually low, 3%, 2-3% long bonds, government Treasury bonds, 30-year, 10-year bonds forever. And when they start going to from 2, 3 to 4, 5, 6, 7%, we're going to have to strategically default, which means you just print more money to pay off the existing debt. That's basically probably where we're going. Anyway, I'm rambling. That's fundamental stuff. Technicals are going to be your better guide because you can really say, well, the bullish case would be if the stock market melts down, treasuries get a flight to safety bid. The bearish case will be, hey, if we can't agree on the debt ceiling, the U.S. defaults on their debt. They did it before back in 2011, brief, and then you can see a sell off in treasury bonds, which cause rates to go up, which of course is going to be very constrictive for the economy. Okay, so Randy, what is it? Well, first of all, it is I have no position, no strong opinion right now at this point in time, but what I'm showing you is there's the range. Solid break above, bullish. solid break below, bearish. All right. And also not just bullish for equities. That is bullish for the stock market. Or no, not necessarily, because that could be a flight to safety bid. See, it gets complicated if they're buying it for a flight to safety bid. But if we go down, it's because interest rates are going up, and there's no way that's a net positive for the stock market or the banking system, which is really in precarious position right now. So we'll watch that. And again, anything big, I'll try to get it out to you. Also watch the spreads on credit spreads. You can go to the Fed's website, which is or Federal Reserve's Fred. But you can also just watch things like junk bonds, JNK and LQD. And junk bonds are flirting with, everyone talks about how the credit markets are holding up. Well, look, junk bonds are in a precarious position. This was that was when everything collapsed when COVID hit. The Fed bailed them out. They used emergency charter powers to bail out the junk bond market. They were able to directly buy even ETFs such as this one and the other one was that. Oh gosh, I'm covering so many things here. The other junk bond ETF is HYG, and they were buying those, and you want to watch these, because if we start taking out those lows, that's a very bad sign. That means you're finally seeing the junk bond market roll over. Low credit quality bonds fallen. They supported this one as well. These are companies that were credit recently changed in their credit rating. And so watch all this stuff. It's a lot. I know it's a lot, but I'm going to give you some clues. Munis, I've talked about munis. I talked about California. Watch PCZ for the California muni market. And then I gave you the bond insurers, the big ones such as MBI. These are official trade ideas of where we hit T1, we hit T2. Look at MBI continuing to fall. So like everything else, it has this divergence. So if the credit markets stabilize, the banks stabilize, the credit markets, this one will probably never see T3. As of now, we're in a bear market. We've been zigzagging since it put in that first divergent high, put in another divergent high. That's where we shorted it, and I think it's going a lot lower. The other one I gave you, AMBAC, AMBC, and you can see we just hit T2 yesterday. I touched on that. I already updated that, and I still maintain these additional price targets. I gave you back around the time I threw these two out. I gave you TIPT, Tiptree, already hit T2. See, look, we're tapping it, boom, boom. And so as soon as it breaks, which I think it will, then we go down to T3. That's my next target, was since we've shorted this one back here. And so if hit, that's going to be a 35, 36% gain. And so like I said earlier, these are some of the things that when I see the comments, I made this comment earlier in the video that about the being in QQQ and the fangs just won't roll over. And that's one of many positions. MKTX, we gamed like a champ, didn't milk every penny out of it, but went long somewhere here on the breakout. Had two targets, 1, 2, I believe were hit. And I had these lines on there, so that was the final target. But then when it got here, I put an update that we are at resistance with negative divergence, and it would be a short on there. And gave you 1, 2 targets, and the second was just hit. And the last update I did in a video, we were coming down, we were in the midpoint, and I told you I had an order to cover right above that reaction high, because that was just above the initial target in the area around 291, and we hit it the other day. So that one I would be out of. PPO is starting to curl up. I think we milked. That's just big support there. I don't have a position. I think it'll probably bounce from here. You get a bullish PPO crossover. It's good for at least a kickback rally. Where to? But right now, if the market rolls over, you're probably not going to get that much of a kickback. So if I wasn't going on vacation, I'd probably look at maybe going long with that positive divergence on the 60 with a stop. And if I do, and if I decide to, the stop would just be a little south of this level here, a little south of 290. That's a nice risk-reward ratio for a bounce back up there. But again, being that I'm not going to be around, I don't want to have too many positions. Cat, I gave you Caterpillar. That's still a swing trade, still yet to hit T4. We shorted that. Gosh, somewhere up in here on this breakdown, hit T1, T2, T3, and this is still T4. and T5, and I maintain these targets. So here's your industrials are rolling over. Again, all everyone can talk about is how strong the fangs are, but you're seeing industrial, and these industrials roll over. That's not a good sign. The economy is booming. Caterpillar should be selling a lot of backhoes and cranes and diggers and all that stuff, and and they're not. So that seems to be a common thing. And somebody asked me about that too recently. I'm just going to comment since this video is already long enough. They asked about why is moo going down? Commodity has been going up, wheat and other things. And my answer was that moo is, I use the analogy of GDX to gold. Moo is holds stocks, agribusiness, same ones I was talking about, John Deere and Archer Daniels Midland and Tyson Foods. So you have tractor makers and fertilizer stocks and food companies. They're going down because these are individual stocks, and even if the price of wheat continues to go up, doesn't mean that John Deere is selling more harvesters. You see a shortage. You have what's going on in Russia, Ukraine being the one of the largest wheat importers, and Russia threatening to block wheat coming out of the Black Sea again, caused wheat to go up. When we gained that little bounce, I told you I took profits the other day just to take profits. I make it back in. But point is, wheat could skyrocket. You could see a blight, some kind of famine or a drought, and wheat prices could soar. But that's because there's limited supply. The supply is shrinking, and that doesn't mean if you have crops shrinking, are you going to have more farmers ordering more harvesters to harvest the wheat? No, because you have less yield coming out of the crops. So the two don't have to go hand in hand. Usually they do. Usually farm equipment and ag stocks will go up in line with commodity prices, but not always and not necessarily. You need to look behind the why. Why are wheat prices going up? Is it a surge in global demand, or is it something else like that? So I just wanted to comment on that, and it's just another sector rolling over, and there's a great example. We all know commodity food prices are going through the roof. Everyone's crying they can't afford groceries. Their bill's so high. Why wouldn't Tyson be making a ton of money? Chicken's going up, beef, everything else. But no, Tyson's going down. So anyway, that's the takeaway is don't correlate rising commodity prices or don't think that rising commodity prices must be bullish for the ag stocks, the companies, because those are stocks. And I've even seen times in a bear market where gold is going up, but the gold mining stocks are going down simply because they are gold mining stocks. They are not gold. They have their own unique things. They have fixed costs, labor, fuel is a big cost to them. So if you have crude oil going up, that's going to put hurt their profits a little bit. That gold's not, I've always said this isn't 1849 anymore. They're not panning it off the top of the creeks out there in
Market data
Sacramento
connection lost.
anymore. All the surface gold's long been stripped off this earth. So they're digging deeper
Market
and deeper.
data
It's more
connection
energy intensive to
reestablished.
get it out of the ground. And so therefore those are the kind of things that the miners face. All right, and we'll wrap it up. I looked down on my scratch pad. I had one stock I mentioned to you. I know this is the longest video I've ever done, at least in a long time. This was one I looked. I'm from Miami initially. Moved out to Southwest Florida years ago to leave the rat race around, but I'm very, very acutely familiar with the housing bubble out there. It's one of the most unaffordable markets in the nation, and so I was looking recently. When the whole banking thing started, or even before it, I started looking to see who has a big exposure. Bank United has a lot of exposure out there, and that's another one just melting down. Just put in a new multi-year low today, and again, guys, this is what I'm watching, and you can call me Mr. Negative if you want, but if you see a full-fledged banking crisis, and this one could be as big or bigger than 2008, I know many don't say that. And I've heard time and time again, all these so-called experts say we'll never have that again. The banks are in much better shape. Well, the Fed had no idea Silicon Valley and all the others that we've seen so far were going down. Who would ever saw that? All right, so keep an eye on them, and then and keep an eye on the trends. I've shared this with you before. I've given you the you can go into Redfin, you can go to Zillow, you can get all these, a lot of stuff. Look at the trends. Here's the median sale price in Miami. I'm trying to zoom in. There it is, the Miami market. So the median sale price is still holding up right now. We all know that there's a shortage of homes for sale because everyone's sticking in their homes for the low rates. and that was holding up. But look, you want to see where does it first start to turn. You can see the number of home sales has plummeted. It recently hit the post-COVID lows, ticked up a little bit recently, but look at the days on market. This isn't a bad sign. This is what you want to watch. I was very much, the Wall Street Journal called the Fort Myers Cape Coral market ground zero of the housing crisis back when it was happening in 2008, 2009. I worked at the regional banks at that time. I had at least 2 branch managers, I recall, making good money, that walk away from that just to flip properties. Everybody and their brother, the guy that cut my grass, everyone was flipping properties. It was crazy. And so I saw, and the way it happened is the first thing that happened is prices didn't turn all. It's not like the stock market. They didn't all of a sudden from going up, start going down. They flattened out. It took about a year or so, and everyone thought, oh, okay, it's just a little slowdown in the market. And then at once, everybody realized they had all these lots and all these homes, and they started all selling at once, and then it snowballed down. And so these are the trends I watch for. I look at things like this in Miami, the days on market. It peaked down here. Everything was selling fast. Look at this. This is, you can see the trend ticking up. So we have days on market to approaching where it was, pre-pandemic levels now. And, it's maybe too early to say that's not just a blip, but those are the things I'd be watching. And the other ones, let's see, demand. You can click on demand, sales to list price. Let's click that to 5 years. Number of homes selling above their list price. It recently surged. 30% of homes were selling above list, and we're back down to pre-pandemic levels. So it looks like things, and this is a big one too, homes with price drops. Look at this really catching up. And I encourage you, go to the hot markets, go to your market and check these out. So we bottomed back here, and I think that you can apply trend lines to things like this as well. There's your trend line. Homes with price drops, the market was hot. That trend broke, and it's been stair-stepping higher, and we're seeing, again, this return to pre-pandemic levels. And the affordability is some of the worst in the whole nation over there in Miami. And again, you can do this in any of the markets. And, and just one more thing to watch. All right, guys, I've got to wrap it up here. Again, like I said, one of the longest videos, but the good news is you won't have to listen to my voice again for at least a week. So I'm going to wrap it up here. Have a great, for me, a great weekend because it starts tomorrow. Anywho, I'll try to get any updates out to you, like I said, if I can and will, over the weekend or during the week. And not much more to add. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.